is cooking up a plan that could completely reshape how international trade and finance work for all of us. And right at the heart of this whole story is a massive question. Could this be a real challenge to the US dollar's dominance? To figure that out, we've got to look at what they're actually proposing. So the news that really kicked all this off, reported in the Times of India, is a pretty groundbreaking idea from India's central bank. The proposal? To link the official digital currencies of all the BRICS nations. Now, this isn't totally out of the blue. It builds on an earlier declaration from a BRICS summit that called for their payment systems to work better together. Okay, but before we get into the grand strategy, we need to get on the same page about the tech here. This whole plan revolves around something called a CBDC. It's a term you're going to be hearing a lot more of, so let's break down what it actually is. A central bank digital currency, or CBDC, is basically a government's version of digital cash. The easiest way to think about it is this. The money in your regular bank account is technically an IOU from that private bank. But a CBDC, that would be a direct IOU from the nation's central bank, just like the physical cash in your wallet. Now, this slide is so important because it clears up a huge misconception. A CBDC is not cryptocurrency, not even close. You can see right here, a CBDC is issued and controlled by a central bank, backed by a government. Crypto, like Bitcoin, is decentralized, and its value is all about market speculation. The key difference here, the thing to remember, is control. CBDCs are all about centralized state control. Okay, so now that we know what a CBDC is, let's get back to the big picture. What is the grand vision for the BRICS countries? I mean, why go through all the hassle of linking these things across borders? Well, according to the reports, the goals are part economic, part strategic. On the one hand, yeah, they want to make trade faster, make it easier for tourists to spend money, and just make all international transactions way more efficient. But it's that last point. That's the one that makes everyone sit up and pay attention, reducing their reliance on the US dollar. And this quote from Reuters just nails it. This is not just some technical upgrade to their banking systems, it's a strategic move. In a world where geopolitical tensions are on the rise, having more control over your own financial plumbing is a massive advantage. But here's the reality check. Having a powerful idea is one thing, but actually making it work is a whole other story. Research from Emory Law gives us this great way to understand the massive challenges involved. Turns out, trying to build a system like this runs into 3 huge hurdles. The first one is what they call the people hurdle. It's the social part of the equation. And really, it boils down to this. You have to get a bunch of very different countries with different cultures, different economies, different political goals to all agree on one single, incredibly complex set of rules. And this table just illustrates the problem perfectly. I mean, look at these competing interests. The EU is all about digital sovereignty and privacy. China's main goal is to make the yuan a global currency. India is focused on speed and efficiency. The G7 is talking about energy use. So how in the world do you build one system that satisfies everyone? It's a huge governance nightmare. The second obstacle is the tech hurdle. This is all the physical, material stuff. We're talking about the nuts and bolts, the actual data, the code, the platforms, the security that has to work perfectly and safely across multiple countries. Think about it. Every single digital payment has to go through these steps. Data gets captured, used, transferred, and then stored. A disagreement or a technical glitch at any one of those stages, like, say, whose privacy laws apply when data crosses a border, could jam up the entire system. Now, one of the really powerful tools they might use to solve some of these problems is something called a smart contract. This is basically code that automatically executes an agreement. For a BRICS system, it could automate really complicated things like exchanging currencies or running compliance checks, which would make things incredibly fast. But, and this is a huge but, this power comes with a massive risk. What happens if there's a bug in the code or the data it's using is wrong? Because these transactions are often irreversible, a single little coding error could set off a chain reaction of enormous financial losses, with no clear way to ever get that money back. There's no undo button. And that leads us straight to the final hurdle, the time hurdle. This is the simple fact that everything is a moving target. Technology, regulations, even global politics are changing all the time, which creates brand new, totally unpredictable problems down the road. I mean, just look at how fast things are moving. The rules you write for today's technology might be completely out of date in just a few years. This insane pace creates all these gaps in regulation and new kinds of arguments that nobody has even thought of yet. So after all that, where does this leave us? What's the real takeaway here? Well, the core conflict is pretty clear. You have a simple, really powerful idea that's running headfirst into a wall of incredibly complex human, technical, and political realities. At the end of the day, this BRICS digital currency project is so much more than a tech experiment. Whether it succeeds or fails isn't just about making payments faster. It's about who gets to write the rules for the next generation of money. And that leaves us with a final and pretty heavy question to think about. As different groups of countries start building their own digital currency systems, each with their own rules and priorities, will money itself become the next global battlefield? The answer to that is going to shape the world economy for decades to come.